Hey everyone, listen, I need to tell you about something absolutely insane that just happened in the last 48 hours. And I'm not exaggerating when I say this might be one of the most dramatic market moves we've seen in years. So picture this. It's Monday morning, December 29th, 2024. Silver prices hit an all-time record high of 82.62 per ounce. I'm talking a historic moment, the highest silver has ever been. People are celebrating, traders are going crazy, and then, boom. Within hours, silver crashed 8.9%, the biggest single-day drop in almost 5 years. We're talking a $72 drop from 82. That's a 10-plus swing in one day. But here's where it gets even crazier. The very next day, Tuesday, December 30th, silver rebounds 10% plus and climbs back above $77. So you've got this absolutely wild roller coaster happening in real time, and honestly, there's a much bigger story here that nobody's talking about. Stay with me, because what I'm about to show you explains why this happened, what's coming next, and why experts are saying silver could hit $100 in 2026. And trust me, this affects way more than just silver traders. Part 1, the wild 48 hours. What actually happened? All right, let me break down exactly what went down in the last 72 hours, because the timeline here is crucial. Sunday night, Monday morning, December 29th. Silver futures surged to a record high of $82.62 per ounce, and spot silver hit $83.99. This was historic. Silver had never been this high before. The previous all-time high from 1980, we just shattered it. People were euphoric. But then something happened that sent shockwaves through the market. Monday afternoon, spot silver plunged as much as 8.9% to 72.11, marking its biggest intraday decline since September 2020. That's a 5-year record for the steepest drop. The iShares Silver Trust, SLV, the world's largest physically backed silver ETF, fell 10%, its biggest drop since 2020. According to Jim Wyckoff, senior market analyst at Kitco Metals, these were some of the worst one-day losses in the history of trading in both gold and silver going back 50 years. Think about that for a second. 50 years of trading history, and this ranks among the worst single-day drops ever. The immediate triggers. There were actually 3 major catalysts working together. 1, when you see gains like that, some people naturally want to cash out, especially at year-end for tax purposes. 2, CME margin. Hikes. This is huge and most people don't understand it. The CME group raised initial margins for March 2026 silver futures to $25,000 per contract, a 13.6% increase from the previous $22,000 level, marking the second such hike in less than 14 days. What does that mean? It means if you're trading silver futures with leverage, it just got way more expensive to hold your position. This forced many traders to sell immediately. 3, China factor. Over the weekend, news broke about China's upcoming export restrictions on silver taking effect January 1st, 2025. Tesla CEO Elon Musk warned that China's export restrictions on silver were not good, writing on X that silver is needed in many industrial processes. This actually pushed prices up initially, but then created panic about supply chain disruptions. But here's what you need to understand. This 48-hour drama is just the surface. There's a much bigger structural story happening beneath all this volatility. Part 2, the bigger picture. Why 2025 was silver's year? Okay, so we just talked about the wild last 48 hours, but zoom out for a second and look at the full year of 2025, because Tuesday, December 30th, silver futures jumped more than 10%, with March delivery rallying 10.59% to close at $77.92. So we go from historic high to massive crash to strong recovery, all within 48 hours. This is extreme volatility, and here's the question everyone's asking. What caused this? What happened is actually historic. The stunning annual performance gold gained around 70% in 2025, and silver more than 150%, with both metals on track for their best annual performances since 1979. Let me repeat that. Since 1979, that's 46 years ago. To put this in perspective, the S&P 500 gained about 17% in 2025, still solid. Bitcoin had a strong year. But silver absolutely destroyed everything. With 160% plus gains, silver emerged as one of the strongest performing commodities in 2025, appreciating 162% and outperforming most major stock indices and currencies. Think about what this means. If you invested $10,000 in silver at the start of 2025, you'd have over $26,000 by year end. That's wealth building territory right there. What drove this explosive rally? There are 5 major factors, and each one is important. 1, industrial demand surge. Silver is commonly used in electronics, including solar power panels, data centers, and electric vehicles. And all of these sectors are exploding right now. Peter Krauth notes that about 80% of data centers are located in the US, and their demand for electricity is expected to grow by 22% over the next decade, with AI alone expected to add 31% growth on top of that. And guess what powers those data centers? Solar energy, which requires massive amounts of silver. 2. Supply deficit, 5th year running. This is critical. Metal Focus forecasts a 5th straight year of a silver supply deficit for 2025, coming in at 63.4 million ounces. That means for 5 years in a row, we've consumed more silver than we've mined. Think about that. You can't sustain that forever. Eventually, you run out of above-ground inventory. 3. Geopolitical tensions. The rally was supported by elevated central bank purchases, inflows to exchange-traded funds, and 3 successive interest rate cuts by the U.S. Federal Reserve. When the world feels unstable, people buy precious metals. We've had a Russia-Ukraine conflict ongoing, Middle East tensions, U.S.-China trade issues, Trump's aggressive tariff policies. All of this drives safe haven demand for silver and gold. 4. Weaker dollar. The Bloomberg dollar spot index was down 0.7% for the week, its biggest drop since June. A weaker dollar is generally supportive of gold and silver. When the dollar weakens, commodities priced in dollars, like silver, become cheaper for foreign buyers, driving up demand. 5. Interest rate cuts. Lower borrowing costs are a tailwind for precious metals, which don't pay interest, and traders are betting on more rate cuts in 2026. When interest rates drop, the opportunity cost of holding silver, which pays no dividend, decreases, making it more attractive relative to bonds and savings accounts. The perfect storm all. 5 of these factors came together in 2025 to create what analysts are calling a perfect storm for silver. But here's the thing. Many of these factors aren't going away in 2026. In fact, some are intensifying, which brings us to the really important question. Part 3, the supply squeeze. This is where it gets serious. All right, this is where things get really interesting and honestly a bit concerning for anyone who uses silver-intensive products. The 5-year deficit reality, I mentioned this briefly, but let me drive this point home because it's absolutely crucial. Silver is in an entrenched structural deficit tied to a multi-year mine supply shortfall that can't keep up with both rising industrial use and strong investment demand. Here's what that means in plain English. Imagine you have a savings account with $100,000, but every year you spend $105,000. So you're dipping into savings by $5,000 annually. Year 1, no big deal. Year 2, still okay. But by year 5, you've burned through $25,000+ of your savings. That's exactly what's happening with silver. We've depleted above-ground inventories for 5 consecutive years. And we're not talking small amounts. The deficit for 2027 is forecast at 63.4 million ounces, though it's expected to retract to 30.5 million ounces in 2026. But even at 30 million ounces, we're still in deficit. The supply can't catch up. Why mining can't just make more silver? You might be thinking, well, why don't mining companies just produce more silver if prices are so high? Great question. Here's the problem. Time. It takes 7 to 15 years to go from discovering a silver deposit to actually producing silver. You can't just flip a switch. Cost. Modern mining is incredibly expensive. Environmental regulations, permitting processes, community consultations, all of this adds time and money. Silver is usually a byproduct. Most silver comes as a byproduct of mining other metals, copper, lead, zinc. So even if silver prices triple, it doesn't necessarily make a copper mine more profitable overall. Labor shortages. The mining industry globally faces severe labor shortages and aging workforces. The Shanghai premium story. Here's where it gets even more interesting. Premiums for spot silver in Shanghai rose above $8 an ounce over London prices, the biggest spread on record. Think about what that means. People in Shanghai are willing to pay $8 more per ounce than people in London. That's not normal. That's desperation for physical metal. According to Wang Yanqing, analyst with China Futures Limited, the speculative atmosphere is very strong. There's hype around tight spot supply, and it's a bit extreme now. But here's the thing. Is it really hype if the supply is genuinely tight? China is the world's manufacturing powerhouse. They need silver for solar panels, massive domestic solar build-out, electronics manufacturing, 5G infrastructure, electric vehicles. What happens when supply runs short? Some analysts are predicting we could see severe supply shortages within 12-24 months if current trends continue. What would that look like? industrial users scrambling to secure supply, prices potentially spiking to 100 plus, possible substitution in some applications, but silver is often irreplaceable, manufacturing delays in critical sectors. This isn't fear-mongering, this is basic math. You can't consume more than you produce indefinitely. Part 4. The margin hike controversy. Is someone trying to stop the rally? Okay, this section is going to be a bit controversial, but we need to talk about it because people are asking serious questions. What are margin requirements? First, let me explain what margins are in simple terms. When you trade futures contracts, you don't pay the full value up front. You put down a margin. Think of it like a deposit. If silver futures are worth $100,000, you might only need to put down $20,000 as margin. This is called leverage. You control $100,000 worth of silver with only $20,000 cash. The CME's controversial decision, the Chicago Mercantile Exchange, CME, announced its second margin hike in just 2 weeks, raising the initial margin requirement for the March 2026 silver futures contract to approximately $25,000, up from $20,000. So overnight, if you were trading silver futures, you suddenly needed $5,000 more cash in your account. If you didn't have it, you were forced to sell, called forced liquidation. The timing raises eyebrows. Here's why people are suspicious. The catalyst for the current volatility was the release of CME advisory. No, 25 and 393 on Friday, December 26, 2025, with the market still reeling from a Christmas week surge that saw silver outperform every other major asset class. So right when silver is at all-time highs and retail traders are making massive profits, suddenly the exchange makes it much more expensive to hold positions. The Silver Thursday comparison. The sudden liquidity drain has reignited haunting memories of Silver Thursday, the 1980 market collapse that broke the Hunt brothers' attempt to corner the silver market. Back in 1980, silver hit $50, about $200 in today's dollars, adjusted for inflation. The Hunt brothers were trying to corner the market. Then COMEX changed the rules, raised margins dramatically, and crashed the price. Silver went from $50 to under $10. Are we seeing history repeat? The counter-argument. To be fair, exchanges have legitimate reasons to raise margins. Risk management. Extreme volatility means higher risk of default. Market stability. Preventing a bubble that could harm the entire system. Protecting retail traders. Preventing over-leveraged positions that could wipe out small traders. The decision has sparked intense debate over whether silver's rally is overheating or merely entering a volatile consolidation phase driven by structural supply stress and global capital flows. My take, look, I can't tell you what the CME's motivations are, but I can tell you this. When you see coordinated margin hikes right at the peak of a rally, it's designed to force selling, whether that's for good reasons, preventing a bubble, or bad reasons, suppressing prices to protect short sellers. That's for you to decide. What we do know is it worked. The margin hikes contributed to that 8% crash on Monday. Part 5. What's coming in 2026? Expert predictions. 350 words. All right, so we've covered the wild 48 hours, the bigger 2025 picture, the supply squeeze, and the margin controversy. Now let's talk about what comes next, because this is what everyone really wants to know. The bull case, 100 plus. Silver multiple analysts are predicting triple-digit silver in 2026. Here's their reasoning. Peter Krauth as outlook, silver's relentless. Move from under $30 in January to over $60 by December speaks to the tightness in the market, and he expects that key thread to continue running through the silver story into 2026. Clem Chambers' forecast. Chambers sees silver reaching $100 in 2026, referring to silver as the fast horse of the precious metals. He believes retail investment demand is the real juggernaut for the silver price in the coming year. The industrial demand argument. Krauth advised that it is dangerous to underestimate the level of demand yet to come from the solar industry. With AI data centers choosing solar energy 5 times more than nuclear options, the industrial demand thesis is strengthening. The bear case. Volatility and correction risk. Not everyone is bullish. Goldman Sachs warned back in October that silver's rally might not hold. The concerns are extreme overbought conditions. When prices rise too fast, corrections are inevitable. Lack of central bank support. Unlike gold, central banks don't buy silver for reserves, leverage unwinding forced liquidations, could create cascading selling. The roller coaster this week could foretell volatility for gold and silver prices in 2026, with a murky path forward for interest rates. The most likely. Scenario here is my honest assessment. Silver probably consolidates between 65.85 for the first half of 2026, with periodic spikes and dips. The structural supply deficit and industrial demand provide a strong floor, but speculative excess creates a volatile ceiling. By Q3, yet Q4 2026, if the supply deficit continues and industrial demand accelerates, especially from AI, infrastructure, and solar, we could genuinely see $90-$100 for silver, but expect wild swings along the way. This won't be a smooth ride. Conclusion: what this means for you. 350 words. All right, friends, let's bring this home. What does all of this actually mean for regular people like you and me? If you're an investor, the opportunity. Silver is still up 162% for the year, despite recent volatility. The long-term structural drivers, supply deficit, industrial demand, monetary policy, remain intact. The risk, short-term volatility, is extreme. If you can't handle 10% swings in a single day, silver might not be for you right now. The strategy. Dollar cost averaging makes sense here, buying fixed amounts regularly rather than trying to time the market. The volatility works in your favor when you're consistently buying dips. If you're in industry, silver is commonly used in electronics, solar power panels, data centers, and electric vehicles. If your business relies on any of these, you need to think about supply chain security. Lock in long-term contracts. Now, while you still can, substitution possibilities. Where can you reduce silver usage without compromising product quality? Cost pass-through. Can you raise prices to reflect higher input costs? If you're just curious, the silver market right now is a microcosm of larger economic forces. The bottom line looking ahead, analysts expect silver to remain well supported by strong retail and institutional interest, its growing strategic importance, ongoing supply tightness, and expectations of further monetary easing by the U.S. Federal Reserve in 2026. We just witnessed one of the most volatile 48-hour periods in silver's modern history, an $82 peak, an 8% crash, and a 10% rebound. But zoom out, and you see a market undergoing fundamental transformation driven by real supply and demand forces. 2026 is going to be fascinating for silver. Whether you're investing, using it industrially, or just watching from the sidelines, this is a market worth paying attention to. Thanks for sticking with me through this deep dive. What do you think? Is silver heading to $100, or are we due for a bigger correction? Let me know in the comments.